Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about a research report that I have just published in respect to the performance of investment grade apartments over probably the last sort of 8 to 10 years. And the focus of the analysis has been really the Melbourne market, but it certainly is, the factors that I've identified in the analysis certainly apply to the Brisbane market and to obviously a much lesser extent the Sydney market. But really the observation that I have made over the last 8 to 10 years is that apartments have generated very little capital growth, whereas houses, particularly again in Melbourne, have generated between, say, 5 to 8% per annum of growth over that same period. And so what I wanted to do is sit down and work out, okay, what are the factors that are contributing towards this performance? And do we expect that to persist? Will apartments continue to underperform houses, and if we then have an investment grade apartment, what should we do depending on that outcome? And so this podcast summarises my findings, or at least the key findings. But what I would do, particularly if you have an investment grade apartment, I'd encourage you to go to our website and download that report. If you just go to the blogs page, I've posted a blog about it this week. And at the bottom of the blog is a download button that you can download the report. You don't have to give me any details or any of that sort of stuff. You don't have to subscribe to anything. It's available to anyone and everyone. And of course, if you enjoy the information contained in the report and you know of other people that might enjoy reading that information as well, certainly feel free to share it amongst your colleagues, friends and family members. So the first point or first observation, and I'm going to refer to a few charts here, which is obviously difficult to do in a podcast scenario, but again, it might be worthwhile sitting down and just having a quick look at some of those key charts in the report. But what I did is I sat down and looked at the distribution of capital growth in Melbourne, Brisbane and Sydney since 1980. And just like I did last year with houses, what I wanted to do is see firstly, what has the growth been over that period of time and how does growth occur? And like in most markets move in cycles. And also there's a strong trend of mean reversion, which means that in the long run, returns revert to the long-term mean or long-term average, if you like. And that means that if you go through a period of very high growth, typically that period is then followed by a low growth period to really let the market kind of catch up, if you like, and vice versa. If you go through a low growth period or no growth period, typically they're followed by periods of above average growth. Now, apartment returns and capital growth returns have ranged between 6 and 7.5% compounding capital growth over the last 40 years. But the key thing to identify, and obviously Brisbane's the underperformer there, Sydney's close to 7%, Melbourne's close to 7.5% in terms of capital growth rate. Now that's just the median, right? So that's that's the midpoint of all the apartments over that period of time. And certainly it would be reasonable and a reasonable expectation that if you're investing in a high quality apartment, that your capital growth is going to be in excess of that, maybe even 1% in excess of that. So we know, therefore, at least the historic results show us that over the long run, apartments do generate good levels of capital growth. But except for maybe the only exception really is Brisbane between 1980 and the 2000s, so that first 20 years, that seemed to be pretty steady growth at around 7%. But apart from that, over the last 40 years, both in Melbourne, Brisbane and Sydney, growth has typically occurred in periods of around about 7 to 9 years. So we'll get a 7 to 9 year period of typically double-digit growth, so north of 10%, and then typically that will be followed by a period again, of around 7 to 9 years of no growth. And that would be in line with my observations in the property market as well. So we know then that if we bought an apartment in Melbourne 8 to 10 years ago, we haven't received any growth. That in itself isn't necessarily shouldn't be ringing any alarm bells. Certainly, if we had a crystal ball, we would have chosen to delay the purchase. Of course, you don't want to purchase just at the beginning of a low growth period. But we also know that property is a long-term asset, and patient investors are typically rewarded. But obviously, if you've got a good quality investment grade asset, in the long run, you will be rewarded. No one will know when the distribution of returns will occur, but we do know over a very long periods of time, the reward is certainly there. Now, obviously, if property values have been appreciating at, as I said, so 6 to 8% over the same period of time, then there's two components that are going to drive property values. The first one is capital improvement, so people spending a lot of money renovating, adding a third bedroom, doing things that really change the value of that asset. And then also the second component is the underlying land value. And you would have to say that in the main, certainly while there is some renovations and some capital improvements occurring, and there always sort of will be, and that does contribute somewhat to growth, most of the growth is occurring because the underlying land value is changing. And so if the underlying land value is changing, then by definition, apartment values also have to change. Maybe to a lesser extent, if the land value's closer to 50%, whereas a house land value is closer to 80% of the overall value. Of course, a house has more land and will appreciate faster, but there shouldn't be that major disparity between growth rates of apartments and houses, particularly if we see, okay, there's demonstrable evidence that underlying land values have changed. And so that means if we believe that, and I do, then it demonstrates that apartments are intrinsically undervalued. And so I did an analysis, and again, I've got another chart. I did an analysis assuming that you bought an apartment in Melbourne 7 years ago for $600,000, and today that apartment's worth $650,000. So $50,000 of capital growth over a 7-year period. No one's going to be at all happy with that sort of performance, and nor should you be. I mean, you don't invest in an asset hoping that that's going to be the outcome. And then what I did is calculate, okay, if that's intrinsically undervalued, what needs to happen for that property to generate decent returns over a 20-year holding period? So another period of 10 years, in addition to another period of 13 years, I should say, in addition to the 7 years that I've held it. And essentially, we need a capital growth rate of 9.2% to really make up for the period of underperformance that we've currently had. And so that's not unrealistic. We've had periods, particularly in Melbourne, between 97 and 2010. The median growth rate was 10.7%. Between 1980 and 1990, okay, going back a fair while now, but 13.2%. So we've certainly had periods of time where we've got growth above 10%. And we know we need about sort of 9% over the next 10 years to make up for that lost time. So the first 2 points then is growth is never going to be evenly distributed. There's going to be periods of high growth and periods of low growth. And we also know what we need out of an investment is possible based on historic returns. Now we've established that, which is really fundamentally there's nothing necessarily wrong, and we can certainly achieve the returns that we want, even though we've got very little returns over more recent periods. Then it's important to look at what has contributed to this underperformance. And I've got a couple of charts, again, in the report, one that looks at quarterly residential apartment commencements. And commencements are more important than approvals because you might have a project approved, but it may not actually ever get built if they don't get the pre-sales, or someone pulls out, or the project doesn't continue. And the other chart I've looked at is the proportion of listings. And I picked about 5 investment grade suburbs in Melbourne. And I picked the 5 that I just anecdotally know that apartments haven't really performed well in. And I picked South Yarra, Richmond, Hawthorn, Armidale and Prahran. And I had a look at, of all the listings in any given period of time, I think that the data is quarterly, how many were houses, how many were apartments. And both those measures, commencements and listings data, both of them drew a pretty compelling story, or gave me a pretty compelling story that in around about 2008, 2009, the supply of apartments increased significantly. And that peaked at around about 2 years ago. That peak started to come back a bit in terms of proportion. So, for example, in 2011, around about 60% of properties listed in those suburbs that I just mentioned were apartments. By 2017, so 6 years later, 78%, a rise of 18%, or nearly a third increase. 78% were apartments, and that has come back slightly now. It's about 75%. So we've certainly seen a massive influx of supply, new housing apartment supply. Now, I guess the key thing is you can't change the number of houses in a suburb. I mean, you can if you do subdivision and so forth, but typically investment grade suburbs don't lend themselves economically to subdivision, that just the land value is just too expensive. So the numbers tend not to work. So in those well-established investment grade locations, typically the number of houses don't change. But you can change, obviously, the number of apartments, and typically apartments are constructed on busier main roads, just because, again, they lend themselves to a council granting approval in that situation. And a lot of those have been developed over the last 6, 7, 8, 9, 10 years. And so that's where that massive amount of supply has come through. The big thing that was occurring over that time is sales to foreign buyers. So typically the Chinese, for example, but it could be from Hong Kong and so forth. And there was really not a lot of rules or restrictions around selling apartments off the plan to foreigners. And in fact, a lot of residential developers really targeted that market. They would have sales teams on the ground in China selling apartments off the plan, and they would have projects that were built specifically for that market. So the quality and standard of build was typically not what we would, resident Australians would desire or look for. But they were really just pumping that into the market. And of course, that drags down the value of existing stock, because if you've got a whole lot of cheap stock and a buyer that is not necessarily discernible or looking at the core characteristics, don't necessarily make that distinction between a terribly constructed property, particularly if you're buying off the plan, you can't really make an assessment as to the quality of finish. And so a lot of money is attracted into that market. So in 2014-15 financial year, the Foreign Investment Review Board, which is the government board that approves acquisitions by foreigners, they approved over $60 billion of residential real estate in that financial year. By 18-19, which is the most recent sort of data, that's reduced to under $15 billion. So it's really a quarter of where it was, 5 or 6 years ago. So foreigners aren't really creating a lot of demand for new property, and as a result, developers just aren't targeting that market nearly as much. And in fact, in 2019, last year, the government introduced a cap on foreign ownership in any particular developments to no more than 50%. So again, if you're going to build something as a residential developer, you now really have to spec it for local purchases. And that's going to increase the cost of apartments, increase the cost of construction, because the finish needs to be higher, of a higher standard. And so that has two impacts. Reduction in supply, a significant reduction in supply, I might add, of new stock coming onto the market. The fact that a lot of, or at least most of the sites that are economical to develop have probably been developed over the last 10-ish years, and also just the demand from foreigners has reduced significantly as well. So all those things that played out over the last 8 to 10 years are no longer present in this market. To add to that, and something I've been banging on about for a long time, really since 2009, credit started to be tightened. So lending to investors in particular started to really tighten up. And I know that the government has recently announced that they will start relaxing some of those laws from 1 March next year. But certainly that's been a kind of hallmark or a common thread throughout, particularly the last 5 years. And as credit tightening, people's capacity to be able to pay more for a property is also reduced significantly. And so you're not going to see that money flow into the market. That also then creates problems or impairs capital growth rates. Now, if credit's going to be loosened up a little bit and there's a little bit more sort of common sense coming back into that market, that is naturally going to stimulate the capital growth rates in that sector, which is good news. So there's another thing that occurred over the last 10 years that probably won't repeat itself, or in fact sort of loosen up a little bit. There are a couple of other factors that I've discussed in the report, and I don't really want to make this podcast any longer than it needs to be. But again, if you're really interested in that sort of analysis and the charts and the data around it, then I certainly suggest, as I said, go to our website and download a copy of the report. The final point I would like to finish on is that comparing apartments and houses probably isn't a very fair comparison. Particularly, if we think back sort of 7 to 10 years ago, an entry-level apartment was probably half the value or less than an entry-level house. And so if you were contemplating investing in property 7 years ago, it's quite possible that if your budget didn't extend to a house, then the analysis is somewhat moot. I mean, you couldn't have afforded to buy a house in any case. I think most of us would agree that a house probably makes a better investment only because it tends to have a higher land value proportion. Now, of course, houses tend to have a lower rental yield as well, so you're getting less income. And you hope that haircut on the income side, you more than make up for on the capital growth side. So horses for courses, and that's one other thing too. It's good to look at the growth rate, but the rental yields tend to be higher for apartments, and that obviously your overall return is made up of both capital and income. Probably a fairer comparison with apartments would be houses located in sort of secondary locations, so really 15 plus Ks from the CBD, not in those blue chip investment grade suburbs. I think probably if you're going to compare properties in the same or similar price point, that's what you're really comparing against. And in the show notes and in the blog, I've got a link to just one report, for instance, that was a very deep study that highlighted that as you move further away from the CBD, your growth rate tends to peter off quite significantly. So, and it makes sense. It's common sense, right? Particularly in Australia, where we've got all the population centred in a capital city. The capital city, close to the capital city, the better the employment opportunities, the better the education facilities, the better the amenities, the pastime amenities, all these sorts of things. And so naturally, the suburbs located in that sort of inner city ring tend to be the most desirable. And if they're the most desirable, highest demand, finite supply, of course they're going to generate over the long run better capital growth. And it's always going to be that case unless there was a absolutely ridiculous amount of infrastructure spent, which is never going to happen, I don't think. The outer areas are never going to be able to compete with the inner areas. So the house versus apartment sort of debate or comparison, we have to put it in context. It's good to make a theoretical comparison. I think we should always look at the performance of asset classes. And as I said a few weeks ago, hold strong opinions loosely. Don't be attached to the fact that we bought this apartment and it's definitely going to work. Always start with an open mind that, hey, you could have made a mistake. It could be an asset class that may not ever work again. I think we need to leave room for that possibility. But if we're looking at and doing that comparison, I think, we've got to look at the practicalities of how much it would have costed to invest in a house 7 years ago versus what your capacity was at that stage, and whether that was a realistic option. The conclusion of the report is that there has been a number of factors that have contributed to changing the supply of apartments and changing the demand for apartments that probably won't repeat themselves over the next 10 years. And that because all markets move in cycles, arguably apartments are intrinsically undervalued at the moment, and we know that there's always a strong trend of mean reversion in markets. And so it's very likely then that over the next 10 years, the growth rate in apartments will certainly be better than the last 10 years. So if you're holding on to a investment grade asset, I would counsel you to be patient. Hang on to that asset, improve value and management where possible, which I also address in the report, but have that patience, and your patience in the long run should be well and truly rewarded. As I said at the beginning of the podcast, please feel free to visit our website, download a full copy of that report, and spend a bit of time digesting that information. And if you know anyone else that would be interested in reading the report, feel free to share it with them as well. Okay, so that's it for me this week, and until next week, bye for now.